If I had to build an earnings season watch list today from scratch, knowing what I know about how this market behaves when expectations get stretched too far, I would not begin by asking which stocks look strongest. I'd begin by asking which stocks can get hurt the fastest if the story slips, even a little bit. Because that's the game right now. It's not just about whether the business is good, it's about whether the stock has any room left for a disappointment, whether guidance can carry the narrative, and whether investors are buying a company or just renting a dream for one more quarter. Today is Monday, April 13th in New York. And tell me in the comments what day and date you're watching from. And real quick, subscribe and comment John A.G. Best if you value this kind of work. So in this video, we're going to walk through 4 stocks that are showing cracks as earnings season gets going. Not because all 4 are finished, not because all 4 are terrible companies, but because each one has a short-term problem the market may not forgive right now. Some have demand issues, some have margin issues, some have execution issues, and one of them, in my view, is simply carrying too much perfection in the price. That's where trouble starts. Now, before we touch the 4 names, you've got to understand the backdrop. We are heading into this reporting window with a market that looks steady on the surface and a lot less steady underneath. From recent market updates, technology has stumbled out of the gate in this new year, AI spending plans have stayed enormous, and investors have started asking a much tougher question. When do all these giant plans actually turn into clean, durable returns? That's a very different question from the easy one, which is just whether AI is exciting. Exciting doesn't always pay on schedule. At the same time, the consumer side of the market hasn't exactly been running hot. Household pressure, energy shocks, tariff noise, and a more selective buyer all matter here. So you've got a market that can punish weaker retail names because shoppers are picky, while also punishing stronger tech names if the valuation already assumes a flawless quarter. That's the setup. And when that's the setup, you don't need disaster for a stock to fall. You just need a little wobble, a little softer guidance, a little push out, a little delay. That's all it takes. Let's start with Nike. Nike is the kind of stock that fools people because the logo still feels powerful, the history still feels powerful, and the old winning version of the company still lives in investors' heads. But the market does not pay for old memories. It pays for momentum, pricing power, and proof that the turnaround is moving from talk to traction. Right now, the company is still somewhere in the middle of that bridge. Based on recently published numbers, the latest quarter came in better than feared on the headline revenue line, but the details were still uneven. Revenue was basically flat as reported and lower on a currency-neutral basis. Direct revenue moved down. Digital moved down more. Converse fell hard. Gross margin narrowed again, and management tied part of that pressure to tariffs in North America. That is not a company gliding through a clean recovery. That is a company still doing repair work while the market keeps checking the clock. And then there's the part that really matters into the next report, the outlook. The stock did not get punished because people suddenly forgot what Nike is. It got punished because the company signaled another meaningful sales drop ahead, while China remained weak and the cleanup of older inventory kept weighing on the model. You can hear the shape of the problem there. They are trying to protect the brand, reset the assortment, and improve the quality of distribution. But those things do not all pay off at once. First comes the discomfort. Later, maybe, comes the reward. That's why I think the easy bullish line on Nike is a little too convenient. People say, well, the plan is finally in place. Maybe. But a plan being in place does not mean the messy part is over. In fact, sometimes it means the messy part is just becoming visible. If you still have excess product to clear, if digital is not yet humming, if China is still soft, and if margins are still under pressure, then the next quarter can feel like a pause at best and a stumble at worst. A famous brand can absolutely recover. It can also disappoint again before it does. Now let's move to Rivian, because this one is more complicated. With Nike, the issue is a giant brand trying to get its edge back. With Rivian, the issue is whether hope can stay patient long enough for the next phase of the business to show up. I want to be fair to Rivian here. The company has made real progress. From the latest delivery release, first quarter deliveries came in a bit above expectations, production and deliveries were roughly balanced, and management kept its full-year delivery outlook in place. That matters. It tells you demand did not completely fall through the floor after the tax credit change hit the wider electric vehicle market. And the company is not standing still. The lower price platform is still central to the story, and the broader strategic partnership with Volkswagen still matters because it supports the software and platform side of the bull case. But this is exactly where investors need to separate better than feared from clean enough to chase. Those are not the same thing. Rivian can post a quarter that looks less bad, and the stock can still be vulnerable if the next steps feel slow, expensive, or uncertain. The company remains unprofitable, It still has to prove that the path from premium vehicles to a broader market is real, not just desirable. It still has to show that the launch pipeline can happen without more friction than expected. And when a company is asking the market to wait for tomorrow, every delay in today becomes louder. There's another trap here too. Good news in Rivian has a habit of creating sharp bursts of optimism, and I understand why. People like the product, people like the design language, people like the thought that there's still room for a second serious American electric vehicle story beyond the dominant giant in the room. Fine, but liking the possibility is not the same as owning a clean near-term setup. A stock can be exciting and still be a bad place to hide during earnings season. So my issue with Rivian into this next stretch is not that the long-term case is dead. I don't think that. My issue is that the company still needs too many things to go right, without a pause. It needs cost progress. It needs the next vehicle roadmap to stay believable. It needs outside partners to keep executing. It needs demand to hold up. It needs investors to keep giving it time. That's a lot to ask at once. And when a stock needs a lot of things to go right, even one missed beat can matter more than people expect. If you're successful, share your success story in the comments so others can stay motivated. Now we get to Tesla. Tesla is tougher to judge because the market doesn't really value it as one business anymore. It values a car company, an energy company, and a future automation company all at the same time. That can be a blessing when one part is weak and another part captures the imagination. It can also become a problem when the current business starts looking shakier, while the future business is still doing most of the emotional heavy lifting. From the latest company release, first quarter production was a little over 400,000 vehicles. Deliveries were a little over 350,000, and energy storage deployments were also lower than many had hoped. From recent reporting, that left the widest production to delivery gap in at least 4 years, and marked Tesla's weakest delivery quarter in about a year. That is not a trivial gap. That is the core vehicle business telling you the handoff from factory output to customer demand is not especially smooth right now. And once you see that, the next question becomes obvious. What did Tesla have to do to keep sales moving? Well, from the company's current offers, 0% financing is sitting there on some models for qualified buyers. That can help. Of course it can. Incentives move metal. But they also tell you the company is not exactly selling through on effortless momentum. Add in tougher competition, the loss of the federal tax credit in the United States, and pressure in Europe, and you start to see why investors are nervous even before the earnings call begins. Now, to be clear, I do not buy the lazy version of the bear case. I don't think this is as simple as saying nobody wants electric vehicles anymore. High gasoline prices can help the category. Tesla still has scale advantages most rivals would love to have. And the lower cost model effort could lift volumes later, even if it raises fresh questions about margins. So I'm not pretending the business has no answer. My point is narrower than that. The stock is still depending on tomorrow's story, while today's car business keeps asking for support. And tomorrow's story is doing a lot of work. Robotaxis, humanoids, AI, the whole Musk universe. Even the SpaceX listing talk has come back into the conversation. From recent reporting, SpaceX has confidentially filed for an initial public offering. And yes, that kind of headline can absolutely stir more enthusiasm around anything connected to Elon Musk. But sentiment spillover is not the same thing as fixing the quarter in front of you. If vehicle demand remains uneven, if pricing stays promotional, and if the energy side does not fully offset the softness, the market can still hit the stock hard before the next shiny storyline gets a chance to save it. And that brings us to Nvidia, which is the most controversial name on this list for one reason. People hear caution on Nvidia and assume you must secretly be bearish on AI. I'm not. In fact, that's exactly why this one matters. You can be deeply bullish on the long-term build-out and still think the stock is vulnerable in the short run. Those are not contradictory ideas. They are actually how markets work when a company becomes the symbol of an entire theme. From the latest company results, Nvidia just put up another monster quarter. Revenue climbed to a fresh record, data center revenue drove the story again, and the Blackwell ramp remained a major source of strength. The company also said it expects sequential growth to continue through this calendar year. That is the bull case. And it is real. There is no need to invent weakness where there isn't any. Demand is strong. Customer budgets are still enormous. The strategic role of Nvidia in this entire AI cycle is obvious. But here's the problem. A great company can still be a dangerous stock if the market has decided it must stay superhuman every quarter. That's what priced for perfection really means. Not that the valuation looks silly in a vacuum. It means investors have stopped leaving room for friction. And friction is everywhere in this build-out. From recent reporting and company commentary, the pressure points are not just about demand for chips. They include export restrictions to China, power availability, customer infrastructure readiness, optical interconnect needs, and the broader physical strain of trying to build data centers at a historic pace. Some giant projects will slip, some budgets will get revisited, some deployments will take longer than the market hoped. That does not kill the AI story. It does complicate the timing of how revenue turns up cleanly across the whole chain. That's the point people miss. Backlog is great, orders are great, excitement is great. But if customers face delays around power, cooling, permitting, networking, or policy, then the path from demand to recognized revenue can get bumpy. Nvidia can still win the cycle and disappoint a quarter. Those two things can happen together. And with the stock carrying the expectations it carries, even a small bit of roughness can matter. So when I look across these four names, I see the same broad warning expressed four different ways. Nike is trying to heal while the market wants proof right now. Rivian is trying to travel from promise to proof without running out of patience on the way. Tesla is trying to keep tomorrow's dream alive while today's vehicle business is still under real pressure. And Nvidia is trying to stay flawless in a world where the entire AI build-out is colliding with physical limits, policy limits, and timing limits. That is why these are red flag stocks into earnings season. Not because they all collapse, not because they all fail, but because each one has a setup where the next report, or more importantly, the next outlook, can expose exactly where the crack is. So here's my question for you. Which one of these four would you be least comfortable holding into the report? And which one, if it dropped hard, would you actually want to own later? The market is not just testing businesses here, it is testing stories. And stories break faster than fundamentals when expectations get too comfortable. And I'll give you one counterpoint, because I don't want this to sound like empty doom. Sometimes the best buys are born out of exactly this kind of discomfort. Nike could become very interesting if the cleanup starts showing up in cleaner margins. Rivian could become very interesting if the lower-priced rollout stays on track, and the balance sheet support keeps buying it time. Tesla could rip if the market decides the lower-cost model and the broader Musk ecosystem matter more than one ugly delivery stretch. Nvidia could punish every skeptic again if customers keep absorbing supply faster than the infrastructure bottlenecks can slow things down. That's why this is a warning list, not a funeral list. The danger is in the setup, not some permanent sentence. Earnings season has a way of forcing the market to separate what is merely noisy from what is actually broken. And if management teams sound defensive instead of decisive or vague instead of clear, the price reaction can tell you more than the headline beat ever will. That's where the real clue usually shows itself. This is here to help you think, not to tell you what to buy or sell. Use it as education, do your own homework, and make decisions like someone protecting real money, because that's exactly what you're doing carefully.